Well, let me ask you a question. You have a 720 credit score, maybe a 740, maybe even a 760. You paid your bills. You kept your balances down. You were patient. You did exactly what they told you to do. And right now, today, a bank is charging you more than someone with a lower score than yours. Not because the system made a mistake, not because your file has an error, because the financial identity you have is sending the wrong signal. And you don't even know it is happening. This is the dilemma. And do you even know this is happening? I've spent 37 years studying how institutions actually read people, not scores, not income statements, people. And what I keep seeing over and over again is that most people are focused on the wrong thing. They are chasing a number, but the institution is reading a profile. And those are two very different things. Today, I'm going to show you exactly why your financial identity, not your credit score, is the real thing determining what you pay, what you get approved for, and what opportunities stay locked no matter how hard you work on that number. And once you see the specific signals you are already sending right now without realizing it, you will understand something that almost nobody ever figures out. But when you figure it out, it's going to do something great for you. Why fixing the score alone never fixed the access. So I want you to stay with me. This is going to open your eyes, and we're going to see some very, very positive things happen. So welcome, welcome, welcome. I'm so glad you're here today. If you're just joining us, my name is Duane, the Success King. This is the CBL Wealth Blueprint, credit, business, and life working together. And today we come here to go deeper than the surface, not just tactics, not just tips, but the real systems behind the money. Today we're going all in on financial identity. Before we dive in, do me a favor right now. Drop in the chat or in the comment if you're looking at this. Tell me what state are you watching from? I'd love to know where you are watching us from today. I love seeing this because I know one thing for sure. This topic is needed. And two, you already know something is off if you're here and you're watching this today. So you already feel the gap between what you have been doing and what you are getting for it. Today, we're going to close that gap. We're going to name what it is, and we're going to show you a path out of it. Now, let me tell you exactly what we're covering. Three things. Number one, what financial identity actually is. So glad to have you, Florida, and so glad to have you, Las Vegas. But I want you to know what identity actually is. That's number one. Most people have never heard this term, but once you hear it, once you understand it, you cannot unsee it. It will change how you look at every financial move you make from this point forward. Number two, how your financial identity is quietly raising your cost of money right now. We're going to get specific. We're going to talk real numbers, real scenarios, so you can see exactly what this is costing you in dollars. And then number three, what a different financial identity looks like. We're going to talk about the specific signals that change your cost the fastest. And I'm going to show you what this is not as complicated as sometimes people make it and as complicated as the banks want you to think it is. It's not that complicated. We've got a lot of ground to cover today, so let's get straight into it. Let me start with a simple question. What do you think a bank sees when you apply for credit? Most people would say my credit score, my income, maybe my debt to income ratio, maybe my employment history. And yes, those things are on the application. They are part of the picture. But here's what most people don't know. Before you ever fill out that application, before you ever click submit, the institution has already built a profile on you, a picture of who you are financially. Now, you got to get this today. Not just what your score says, but how you move, how you behave, how you look in the context of every other person they've ever seen walk through this same process. That profile is your financial identity. And it is not the same as your credit score. Your credit score is a snapshot, one number, a grade on one specific moment in time. It tells the lender whether you paid your bills. That's it. It does not tell them who you are. Your financial identity is a pattern, a full picture that you're going to get today. Everything you have done, everything you own, everything you owe, and how it all looks together over time in context. Because the truth of the matter is, banks do not just read your score, they read your story. Now, I want to break this down into 3 layers. Because once you see these 3 layers, everything else we covered today is going to click immediately. The first layer is your behavior signals. This is how you use credit, not just what you owe, how you move. Do you pay the minimums every month, or do you pay the full balance? Do you open an account and sit still, or do you actively manage your position? Do you apply for credit every time you feel financial pressure? Or do you apply with a plan? Every one of those behaviors sends a signal, my friends, and those signals add up to a picture. And that picture either says this person understands money, or it says this person is reacting to money. There is a huge difference between those two things. And the institution sees it. And listen, every single time. You've got to know this, because if you learn this, your success in this system is going to increase exponentially. The second layer is your account positioning. This is what types of accounts you have, the mix of them, the age of them, whether your profile looks like someone who's been building a financial life intentionally, or someone who picked up whatever was available at the time. A profile with a seasoned revolving account, a mix of credit types, and a track record of consistent management tells one story. A profile with 2 store credit cards and a car note that got paid late twice tells a completely different story. You can have the same score, but a different story. And if that's the case, there's going to be different terms. The third layer is your institutional relationship pattern. Now, you've got to get this. This is how you look to the actual institution, not just the credit bureau, the bank, the lender, the underwriter sitting on the other side of your application. What products do you hold with this institution? How long have you been a customer? Do you look like someone who is a risk to them or someone who is an asset to them? Because here is something most people never consider. Banks do not just run your credit report when you apply. They also have internal scoring systems that run alongside your and my report. A behavioral score, a relationship score, a risk pricing model that factors in everything they know about how you have behaved as a customer. And that internal score, that second layer of judgment, shapes every offer they put in front of you. Now, here is where I need to say something very important, and I want you to really hear this. The system was built this way on purpose. As long as you are only focused on your credit score, the one number everybody talks about, the one number all the credit repair ads are built around. You are playing the game they designed for you. They built the scoring system. They set the rules. They know exactly how to price you above it. They know how to make money from the gap between what you think your score means and what they actually see when they read your full profile. The score is the game they show us. The identity is the game they are really playing. Do me a favor, drop a yes in the chat if this is landing. If this is making sense, because I want to go and I want to make sure that together we are connected before we go any deeper in this. But I'd like to know if this is making any sense to you. Put a yes in that chat, because I want you to hold this, because what I'm about to show you next is going to make it real. We're going to stop talking in concepts and start talking in dollars. So hear me real clearly. Let's make this very concrete. I do not want to give you theory or send you home without real deep understanding of how this is affecting your life. I see you, yes. How this is affecting your life. I want you to get this, and I want you to take it with you. I want to give you numbers. I want you to see in real dollars what your financial identity is actually costing you, because when you see it, everything, and I do mean everything, changes. Here is a scenario. I want you to sit with this one. Two people walk into the same bank. Same bank. I'm glad to see it. They walk in the same bank. Same week. Same loan product. Both have a 730 credit score. Both report the same income, same debt to income ratio. On paper, they look identical. One person gets approved at 7.9% interest rate. The other person gets approved at 11.4% interest rate. Same bank, same week, same score, same income, but different rate. How did this happen? The answer is financial identity. One profile looked like a managed, intentional financial life. Someone who understood money. Someone who had been building their credit position deliberately. Someone whose file, when read as a whole, said this person knows what they are doing. The other profile told a different story. Someone who got a 730 credit score, yes, but who got there by accident. Who paid on time, yes, but whose accounts showed reactive patterns. Whose utilization moved in ways that signaled instability. Whose inquiry history raised questions. Whose profile, when read as a complete picture, said, this person needed the loan more than they chose to take it. Banks price for risk, and risk is not just about score. I'm going to say it again. Risk is not just about the score. Risk is about the story behind the score. Now, let me show you what that difference in rate actually cost in real money. Let's say you're borrowing $40,000. That's a reasonable number. A business line, a debt consolidation, a major purchase, and you get it at 7.9% over 5 years. Your total interest paid is roughly $8,500. All right, that's person one. At 11.4% over the same 5 years, your total interest paid is roughly $12,400. That is almost $4,000 more for the exact same loan, the exact same amount of money, the exact same 5 years. $4,000. Not because your score was wrong, not because you did anything illegal, not because you were a bad customer, because your identity, the story behind your score, put you in a higher risk category. And that is just one loan over 5 years. Now multiply that across a business line of credit, a mortgage, a vehicle note, a lease on commercial space, a second business loan 2 years from now. The cost of a weak financial identity is not a rounding error. It's not a minor inconvenience. Over the full course of a financial life, it can easily be tens of thousands of dollars, sometimes significantly more, paid out, gone, not coming back, all because the system read you one way instead of another. Now, I want to walk you through the specific signals that move that rate. And you've got to get this. If you get nothing, you've got to get this today, because I don't want you to just feel the cost. I want you to understand exactly where it's coming from so you know exactly what to change. The first signal is your utilization pattern, not just your utilization number, your pattern. Most people know that keeping utilization below 30% is good practice for the system, and it is. But here is what most people don't know. A static utilization of 28% looks very different to the underwriter than a utilization that moves down consistently month over month. The institution sees both, and what they want to see is movement, management, someone who is deliberately controlling their balances, not someone who just happens to sit below a threshold. When your utilization is static, stuck at the same number for months, it says one of two things. Either you found a number and stopped, or you cannot go lower because that is your real position. When your utilization moves down consistently, it says something completely different. It says you understand the reporting cycle. You understand how the system reads your balance. You are managing your credit like a tool, not carrying it like a weight. That is a different signal, and lenders price you differently. The second signal, important, get this, is your inquiry pattern. What you've applied for, how often, and whether it looks like a plan or pressure. Someone who applies for credit 3 or 4 times over a 6-month window, especially if those applications are scattered across different product types, different institutions, different categories, looks like someone who was under financial stress and was looking for any door that would open. Meanwhile, someone who applies once strategically for a specific product that fits their profile looks like someone who knows what they're doing and made a deliberate decision. Same number of hard inquiries on paper can show up, but a very different story in practice, and underwriters are trained to read that difference. The third signal is your account age and product mix. A thin file with one credit card and a car loan tells one story. A seasoned file with a mix of revolving credit, installment products, and a long track record of management tells a completely different story. The depth of your profile, the variety of it, the age of it, tells the institution whether you have real experience with credit systems or whether you are still learning how to use them. And I promise you, it matters. And experience gets priced differently than inexperience, always. The fourth signal is your banking relationship. Are you a transactional customer? Someone who has a checking account and occasionally applies for a product? Or are you a relationship customer? Someone who holds multiple products with the institution, maintains consistent balances, has a history of engagement, has been there long enough to build a track record. Banks have always known that relationship customers are more profitable and less risky. They reward that positioning, not because they're generous, because it is good business for them. And when it's good business for them, it becomes good positioning for you. Now, let me give you a quick story because I want you to see how this plays out in a real situation. I had a client, ran a small service business, good income, worked hard, built himself up to a 718 credit score, could not figure out why every time he applied for funding, he either got a denial or a rate that made the deal impossible. He would fix one thing, come back, still the same problem. He kept thinking, it's the score. So he kept working on the score, and the score went up, and the results barely changed. So we pulled his full financial picture, not just his score, his identity, the whole profile. And the problem was obvious once we looked at the full picture. It was not the score. It was the story behind the score. He had been a reactive utilization pattern person because balances that moved up and down based on business needs and not strategy was what you could see. He had 6 hard inquiries over 18 months from applying under pressure every time he needed capital. He had a thin account mix, 2 credit cards, and 1 auto loan. He becomes a person that I use in my teaching often. And he had no meaningful banking relationship with the institution he was applying to. He was a stranger asking for money. To the underwriter, he looked like someone managing financial stress, not someone managing financial strategy. I wonder if you get that. Which one would you look like? Someone managing financial stress or someone managing financial strategy? Because you're going to have maybe the same score, but you'll have a different story, and it's going to change things. So we shifted the signals. We built an intentional positioning plan. He's the same person with the same income, same credit history as a foundation, but 6 months later, different conversations with lenders. Different offers started showing up, different rates, better rates, different access, same person, but different positioning. And it made all the difference for him. Now, drop something in this chat for me. Tell me, are you seeing yourself in any part of that story? Are you the person who's been doing the right things and still not getting the access you deserve or you desire? Drop it in the chat. I would love to hear from you. And I love the opportunity to read each and every one of these. And I want you to know what you're feeling is not a personal failure. It's a positioning problem. And positioning problems have positioning solutions. That is what we're going to talk about next. And we're going to really dig in. Now listen, now let's talk about the flip side for a moment. We've spent a lot of time today talking about why your financial identity costs you. Now I want to talk about why it does not have to. Oh, this is important. This is the why not. Because every why lesson has a partner. And the why not lesson is the partner. And here it is. Why does your financial identity not have to keep costing you? And the answer is not complicated. Your identity stops costing you more when the signals you send become intentional, when they are consistent, when they are positioned, not reactive. The system does not change. Banks still read the same profile. The underwriter is still looking at the same factors. None of that moves, but what they read about you, that changes. And when what they read changes, your cost changes with it. Sometimes much faster than you expect. Now, I want to give you 3 specific identity signals that change your cost the fastest. I'm not going to give you 10 things to fix. I'm going to give you the 3 that move the needle first, because focus matters more than volume when it comes to identity work. The first one is active utilization management. Not just keeping your balance below 30%, managing it deliberately with timing, with awareness of how the reporting cycle actually works. Here's what most people don't know, but if you watch this channel, I talk about it a lot. Your credit card company reports your balance to the credit bureau on what is called the statement closing date, not the due date, the statement closing date. These are 2 different days, and most people have never paid attention to which is which. Most people pay before the due date, and they think that is enough. And it is enough to avoid a late payment. But if your balance is still high on the statement date, that high balance is what gets reported to the bureau. That is the number the bureau records. That is the number that affects your score, and that is the number that becomes part of your identity profile. When you understand the timing, when you pay down your balance before the statement date, you control what the system sees. You decide what number gets reported. You tell the machine exactly what you want it to read about you. That's not a trick. That is not a loophole. When I say cheat code or loophole, I do not mean something shady. I mean understanding how the system actually works and using that knowledge. That is what separates intentional positioning from reactive management. And that one shift, just understanding the statement date versus the due date, is one of the fastest ways to start changing the signal you are sending. The second shift is building an account depth, not just chasing a higher credit limit. A lot of people believe the goal is to get one card with the biggest limit possible. And yes, a high limit can help your utilization ratio. That's part of it, and that part is true. But one big card on a thin file still tells a thin story. What actually changes your identity is building the right types of accounts at the right time, not opening everything at once, not applying under pressure, opening strategically with spacing, with purpose, a revolving account, an installment product, a business credit instrument. When the time is right, built over time with intention in the right sequence, that is a profile that reads like experience. And here's the key thing about experience. Experience does not just raise your score. Experience lowers your risk category, and a lower risk category means better pricing, not just once, every time you ask for money. So the question is not just, how do I get a higher limit? The question is, what does my account profile say about who I am financially? And is that the story I want to be telling? The third shift is the one that most people never think about. And in my experience, it is often the most powerful one. Where you bank matters. What products you hold at that institution matters. How long have you been there matters. I want you to think about this for a moment. If you walked into a bank you have never visited before, no accounts there, no history, no relationship, and you ask them for $100,000 in business funding, what are the chances they say yes? Now, if you walk into a bank where you've had business checking account for 3 years, you maintain a consistent balance, you have held 2 other products with them, and you have a track record of responsible activity, what changes? Everything changes. Banks price loyalty, not because they're sentimental about it, because loyalty signals stability, and stability reduces their risk. Lower risk means better terms for you. This does not mean you stay at a bank that's not serving you. It means you choose your banking relationships the way a business owner chooses a strategic partner. You look at where you want to grow. You look at what access you will need in the next 2 or 3 years, and you start building toward those relationships before you need to ask for anything. Because the worst time to build a relationship with a bank is when you need money from them. The best time to build that relationship is right now, before the ask, while you still have leverage, while you are building from a position of calm, not pressure. The truth of the matter is, you cannot change your financial identity in one move. It is not a light switch. It's a pattern, and patterns take time to shift. Because here's what I've seen over 37 years of watching people move through this process. You don't have to change the whole pattern at once. You just have to change the signal. You start with one shift, and the system begins responding. And when the system responds differently, you start to see that you have more control over this than anyone ever told you. Now, I want to give an opportunity for questions. We've had some questions sent in, and I want to take some questions from the chat if they're there. If you've been sitting on something, if something we've covered today sparked a question about your specific situation, you can drop it in the chat right now. I'm going to read through some of them and answer some of the questions I get asked all the time as my team is giving me some of these questions from this now. Now, this is important. All right. Great. I see this. So the first question that we have been sent: what is the best thing I could do for utilization? Great question. Here is the short answer. You want to track your statement date, not your due date. Call the number on the back of the card and ask them when your statement closing date is. Then pay 3 or 4 days before that date, not after. That is the only move you need for every revolving account you have. Do it, and you watch what happens. Question 2. How can I build an effective account mix? Here's what I would say. Do not open accounts just to have them. Open them with a plan. What product do you need 12 months from now? Start building the relationship that puts you in position to get it. Do not, I repeat, react. Prepare. Do you know the word prepare is a prefix and a suffix? The prefix pre, the suffix par. The word par means align. The word pre means beforehand. So the word prepare literally means to align beforehand. Do not react. It's too late. Prepare. Align this thing. Set it up before you need it. Question number 3. This is really good. How do you establish good banking relationships? Well, start simple. If you have a personal account at a bank that offers business products, that's your starting point. You already have a relationship. The next question is how to deepen it. Many banks, many credit unions reward you when you have multiple relationship products with them. Do not limit yourself to banks for funding, though, because there are alternative lenders that are also great options. Now, these have been some great questions on today. I appreciate every one of you for being engaged. That is what makes this time different. We are not just watching, we are working. And that is exactly the kind of positioning that changes outcomes. Now, let me bring this all home. Here's what this really means. You've probably spent years trying to fix a number, and the number went up, maybe slowly, maybe faster than you expected, but the number went up. And you thought, okay, now things will open up. Now the access will be there. Now the rate will make sense. And then you applied, and the terms were still weak. The rate was still higher than it should have been. The offer still felt like they were doing you no favor. Instead of competing for your business, they just threw something out. And you kept asking the same question: what am I missing? I paid on time. I kept my balances down. I was patient. I did everything they told me to do. So why is the system still not responding the way I expected? I want to answer that question today, directly, clearly, so you can take this home with you. The number is not the product. The profile is the product. Your credit score tells the system that you showed up. It says, yes, this person paid their bills. That is real. That matters. But that is not the whole conversation. Your financial identity tells the system who you are, how you think, how you behave, whether you are someone who uses credit as a tool or someone who is managed by it. And who you are financially is what determines the terms you get every time, not just today, not just for this loan coming up. Every single time you ask the system for something, you were not chasing the wrong thing. You were chasing an incomplete thing. You were building the score without building the identity behind it. And once you understand that, once you start seeing your financial life as a profile and not just a number, the whole game changes. Because the truth of the matter is you have more control over that profile than anyone ever told you. Not because there's a secret code, not because there's a loophole that fixes everything overnight, but because the system is the system. And systems follow rules. And when you know the rules, when you understand what signals the system is actually reading, you can position yourself intentionally instead of reactively. That is the real lesson. That is the thing that separates people who get consistent access from people who keep being told almost qualified, almost approved, almost there. Almost is a positioning problem. And positioning problems have positioning solutions. Now, before I close today, I want to give you something you can use right now, not next week, today. Here is what I see all the time. People come to me after a video like this one and they say, Duane, I understand the concept. I see the problem, but I do not know where to start. I do not know which part of my financial identity is creating the most friction for me right now. Is it my credit positioning? Is it my banking relationship? Is it my account mix? Or is it something else entirely? And that is a fair question because the answer is different for every person. You cannot fix what you do not have any understanding of. And you cannot identify what you've not been shown how to see. You've probably been told your problem is discipline or budgeting or simply working harder, and those things may matter, but they may not be the root problem. The deeper issue may be a financial system you've not been shown how to see yet. So, my friends, I built a free tool to help you see it. It's called the CBL Financial Positioning Diagnostic. And listen, in about 5 minutes, 5 short questions, it helps you identify which layer of your financial system is creating the most friction right now. Which layer is the one holding you back the most, so you know exactly where to focus first. The link is in the description for this video. There's no cost, no pressure, but a boatload of clarity. 5 minutes. That's all it takes. If you watch today and you want to know where to start, that's your starting point. And if you take that diagnostic and you see the gaps, and most people do, then the next step is the CBL Wealth Blueprint. That is where we take your specific profile, your specific situation, your credit, your business, your life, and we build the sequence, the plan, the positioning that actually moves the needle. Not a generic course, not a checklist you download and forget, a real implementation path built around your numbers, your gaps, and your goals, with diagnosis, with sequencing, with accountability, with someone in your corner who's been doing this for 37 years. This is not for everyone. It is for the person who's been doing the work and is done leaving money on the table. The person who is ready to stop almost and start actually. The link is in the description below. Before I let you go today, do me a favor real quick. If this was valuable to you today, and I believe it was, hit the like button right now. It's so important. If you hit like, YouTube is going to share this with more people. And I really appreciate you hitting that like button, because there are people watching from their phones at 11 o'clock at night who need this exact conversation. And every like helps put this in front of them. So I really appreciate it. Subscribe to the channel if you're not already subscribed. We go deep every Monday, Thursday, and Friday on the long form videos. And every Wednesday, we are here live going through the real systems, not the surface, the real systems. And drop a comment below before you leave today. Tell me, what was the one thing from today that hit different? What is the one thing you are taking with you? I read every single comment, every one. And I'll be back here our next time going through more great information to help you. Thank you so much for being here today. This matters, not just as information, as positioning. Every Wednesday that you show up, every time you learn how the system actually works, you are building the kind of knowledge that changes what's available to you. That changes what you get approved for. That changes what you pay for money. That changes your access to opportunity. That's not small. That's work. And you showed up for it today. I look forward to seeing you again real soon. If you have not already, take the diagnostic, 5 minutes. Link is in the description. Be blessed. I so look forward to seeing you again right here real soon. You take care, my friends. Be blessed.